Thanks for coming, guys. And today we're talking about concentrated liquidity pool yield farming. And the reason why we're talking about this is because a lot of people have been asking me about it. I've been yield farming since around 2023, around like the end of 2023. And I've spent like a couple thousand, hours trying to learn how to like provide liquidity. And then even now I'm learning new things about like yield farming and DeFi, right? So it is a pretty complex topic, but hopefully this workshop, along with like some other workshop that we could be doing in the future, would help you become a better liquidity provider or yield farmer or DeFi investor. So the DeFi sector is pretty broad, but I mainly focus my efforts on concentrated liquidity pools because I like to invest into assets and to have like a market exposure rather than like being delta neutral with my holdings. So concentrated LPs is a really good way to earn passive income doing that and to accumulate different tokens that you believe in. If you guys hold like a Sappy Seals or hold Pixel, you could be earning Pixel and ETH, for example, right? If there's like Pixel and ETH inside the liquidity pool, whenever someone trades, you're going to be earning the underlying token. So this workshop would cover what is a liquidity pool, the pros and cons of providing liquidity, just like trading, swing trading, day trading, there's pros and cons of each, right? For example, swing trading is less time consuming, but maybe the opportunities are fewer than like, let's say day trading. But for day trading, it's like, you got to be locked in and like on top of things when you start trading, right? And it's much more time intensive. And it's very similar with like providing liquidity. There's like pros and cons with each strategy. And I will record it so that you guys can watch the recording unless, something bugs out with the recording. But it looks fine right now. We're going to be going over like the pros and cons, how to scan, simulate, and deploy a liquidity pool. For this workshop, we're probably going to be focused on the simulation part, just because there's no pools on mainnet yet, right? Because mainnet is not live. But I will show like an example of how to like look for pools using tools like Gecko Terminal, because maybe some of the other LP scanners might not support Monad yet, and that typically is the case for like newer chains. So it's really good to like know the different tools so that you are, better off than like 90% of other liquidity providers, right? And then I'll go over some beginner strategies as well as some intermediate and advanced strategies. And for beginners, it's typically a good idea to like try and not to overcomplicate things too much, because if you're trying to like run too complex of a strategy, there's much more things that could go wrong, right? And yeah, like Merrill says, it's really cool if you can test the LP. I believe there are like a couple dexes. I'm not sure on like stuff like Kuru if there's concentrated liquidity or not, but I believe on like Uniswap and maybe some other exchanges, Atlantis or something, there's like concentrated liquidity pool. You could try those apps there for basically free, right? To kind of get a feel of things. But yeah, for this workshop, we're going to go over all of that. And just a quick introduction. I was able to go from like 0 to a few six figures from crypto in like under 4 years. I started as like a freelance artist working for like a few NFT projects earlier on. I made a bunch of money, but also lost a bunch of money in the space. Recently, I co-founded Drippy Finance with Cornelius, and we're both part of the Illuminati team. And our mission with Drippy is to help people reach financial freedom faster through DeFi. And Drippy is going to be kind of integrated with Illuminati as well. We're hoping to like through our sales, through like coaching or like online courses and stuff like that, or basically raising funds from the ground up to build some software to help like liquidity providers and investors make better investment decisions, right? So that's kind of our mission there at Drippy. And it directly ties in with the Illuminati. And it's already like a profitable business, even though, it's still like quite small, right? So we are building in the space. And I really like concentrated liquidity pools simply because, again, I could take a market exposure. I could have a bias. I could lean bearish. I could lean bullish. And I could adjust my exposure at any time. and I earned really nice fees in the process, right? Through concentrated liquidity, I was able to replace basically whatever other income I was making as a freelance artist. I also work as like an investment manager and a consultant. So my income is a bit more than what I was earning as an artist, but still concentrated liquidity is a pretty great way to earn passive income, especially if you hold a lot of crypto. And you guys can follow me on X and YouTube as well. My YouTube goes over a lot of these concepts in detail for basically free. It just takes a little bit more time if you're learning by yourself to go through the materials because there's just simply a lot to learn, right? If you guys want to take notes, you can, but don't worry about it if you can't, because I will record it. And like it's some of the concepts might be a bit confusing. Yeah. But what is a liquidity pool? So if you guys have made like an on-chain swap before, whenever you're interacting like with like different dexes, you're interacting basically with a liquidity pool most of the time. Stuff like Uniswap or Radium, Solana on like Solana or on Orca, for example. You're actually to be able to swap, for example, Ethereum for some USDC on chain, you need to go through a liquidity pool, right? Because there's actually not like the order book on like centralized exchanges where people are like placing buy and sell orders and stuff like that. So when people swap, liquidity providers like us would make money in the process, right? So at launch date, if you guys are providing liquidity for maybe like MON and USDC, then you're going to be earning the swap fees that traders might be swapping, right? And it's typically a great idea, especially if you're looking to accumulate more MON to be providing liquidity, especially on launch day where the risk and reward is much greater, especially if you're getting an airdrop as well. And the reason why the risk and reward is greater on launch day is simply because usually the first few days for liquidity pools, you're going to see a lot of volume, right? But there are a lot of traps as well that I will go over a bit later on. Like, for example, setting your ranges too tight and then you're forced to rebalance all the time. You could actually end up with less money than what you got started with. And I'll explain why in this workshop as well. There's pros and cons with each strategy, right? But the good thing about the liquidity pool is that it's much higher yields than like lending, borrowing, or staking. If you're staking Monad, depending on how like the tokenomics work, it's probably not going to earn you more than like 10% APR, right? Unless it's like highly inflationary and you're kind of like forced to stake to not be diluted at that point. Or if you're lending out MON in different lending protocols, if like Aave is integrated, for example, or different lending and borrowing protocols, it's probably not going to pay you that much yield as well. And there's a ton of flexibility and strategies to choose from. And again, it depends on your skill level, and then it also depends on your market outlook. And it's one of the best ways to accumulate assets that you are bullish on, right? So, for example, if you're pairing MON and USDC, you're going to be accumulating MON and USDC in those pools as fees. If you're pairing stuff like, for example, CHOG and MON, and you're bullish on CHOG, and typically there will be like a liquidity pool that you could yield farm on, then you're going to be able to accumulate both CHOG and MON from that pool, right? And depending on your strategy, it could outperform or underperform just holding your assets separately and with wider ranges, which is what I recommend to like beginners and even to advanced people and to all of my clients, is because it's easier to outperform holding and it's way easier to make a profit in the market with a wider concentrated liquidity. And it tends to outperform holding in the market over time, especially if prices don't move too aggressively. I've been providing liquidity for stuff like Pixel to ETH, for example. And especially if the prices are kind of like staying in the range of, let's say, like 2 cents and 10 cents for a very long time, like what it has been doing, our performance as liquidity providers are going to be much, much better than like just holding in the market. Especially, I can pull up like the profit and loss for you guys to see too. And it's not all like rainbow and sunshine. You got to know like what you're doing. Sometimes we'll be sitting in like a pretty deep loss. But yeah, with like Mr. Pancake says, with wider ranges, sometimes you barely earn anything. It depends on what you mean by like a lot or anything. For example, like really wide blue chip pairs, for example, ETH to Bitcoin could probably only be like 2 to 3% per year. But if you're looking at like currently in like a full range pixel to ETH pool right now, it's pulling like 40% APR, right? So it all depends on the underlying asset. But does it mean that I would, actually make money long term? It depends on the underlying asset, right? So if Pixel goes to zero, I would still earn fees in the process, but it's very likely that I would be losing money over time. And if the market is kind of weak, then, I'm going to be earning less fees over time, right? But if you're running with pretty wide ranges, like for example, HYPE to USDT here, I have my range from like 20 to like infinity. This is the max upper range one, and it's pulling like a 16% APR. There's some imperil loss here, and it's not outperforming holding, but over time I can, if that's my goal, if I earn more and more fees, right? Let's say it's like $10 a day over like, another 3 to 5 days, I would be outperform holding in the market. But oftentimes it's a mistake to, overanalyze this versus HODL number. And you want to look at like your overall profit and loss instead. And sometimes you will be in like a negative. For example, if we see here, it's a negative US dollar profit and loss because Ethereum and Pixel kind of like went down in price a little bit. But if you look at like the divergence loss here, you can see this metric basically outperforms like holding 100% Pixel, 100% ETH. If I split it 50-50, again, this is like the ideal scenario where you could basically outperform everything. And of course, it doesn't happen all the time, right? So there's a lot to learn, but over time, I've had a pretty good track record when it comes to providing liquidity. Give me 1 second, guys. Let me try to see here. Let's move on with the course material for now. But it is a fairly passive strategy if you use wider ranges and more sustainable strategies. And someone did mention like correlation beforehand. Typically correlation, like most crypto to crypto pairs are correlated in some sense, where like if the whole market dumps, typically like two crypto tokens do dump together, like for example, Pixel and ETH moving together. But at the same time, in my opinion, correlation is not that much of a factor that you should be using when you're providing liquidity, because when sometimes there's like negative correlation where like if a token, like for example, Pendle and Ethereum, Pendle is like a DeFi project, right? I'm currently in this pair. So there was a period of time where like Pendle is not correlated to Ethereum, right? So if you guys look here, back in April of earlier this year, ETH went down, but Pendle went up relative to ETH, right? So in this case, you will be suffering more impermanent loss, but you will be able to close your position in an Ethereum profit. So you might be down in US dollar value, but let's just say you start with 10 ETH. Maybe you could have closed your position for like 15 ETH, right? So you are profiting in ETH terms, and then you could close your position in US dollar profit once Ethereum recovers in price. So that's a bit of a more like an advanced, more like intermediate and advanced concept. But when there's like price divergence, you could actually profit from it. So a lot of people talk about like impermanent loss, but not enough people talk about, like how to actually take advantage of that, right? So, but yeah, it's fairly passive. And then let's go over like the downsides. There is something that is called impermanent loss that I just mentioned. And what it basically is, I will show like with an example with MON and USDC, just so that it's easier to understand for beginners. And this is a free impermanent loss calculator that you guys could use. And let me share it here. Yeah. So 1 second, let me set it up and then you guys could use this. But basically the price now, let's just use the Monad pre-market price on Hyperliquid. Let's call it 0.055. So this is what I want to key in here. Price now 0.055. Price deposit, let's say you're depositing right now 0.055, and then price lower, let's just call it at 0, and then price upper, let's put it at infinity. So this, in a sense, it's like a full range LP, right? So effectively a full range. So let's start with that, and then we'll work into the concentrate LP. So let me save this and then share it here. But basically, what I want to show you guys is, let's say you deposit right now, right? And because it's a full range pool, if you guys don't already know, you have to deposit roughly a 50-50 ratio. So let's say you're going in with like $100,000 and I'm just using 100K simply because it's an easier number to see, right? So if your LP value drops to 50K, you've made a 50% loss. So let's just call it 100K. It's a 50-50 pool. What you're depositing is 50% MON and then 50% USDC, right? So you would have $50,000 worth of MON at this current price. And the amount doesn't really matter too much right now. But basically what I want to show you guys is, let's just say the price doubles, right? So 0.11, the price doubles. What you're going to have is that there's going to be 5.8% of impermanent loss, right? So if you held it separately, you would have around 150K. The reason why is because, again, if MON price doubles and you're holding 50K worth of MON and 50K worth of USDC, you would have, the MON amount would like double in price, right? In the US dollar value. So you would have 150K, and then because you're providing liquidity, some of your MON will be sold on the way up to USDC, and you would end up with like about 141K. So this is what they call like impermanent loss. This is the percentage here. So 5.8% impermanent loss. And theoretically, if your APR is greater than like the impermanent loss, you're going to be outperforming just holding in the market, right? So if the price goes up, there's impermanent loss. And what we also want to understand is that if the price goes down, you would have no impermanent loss, right? If it goes down back to your entry. But what a lot of people do is if they over-index impermanent loss, they're trying to beat impermanent loss all the time. But like in theory, if MON's price goes up really high, sure, you are suffering some impermanent loss. It would have been better to hold your assets separately, but that's kind of like saying I should have went back in time and never provide liquidity, right? So you never know what's going to happen in the market. So you can't like just say that, okay, providing liquidity is bad because you suffer some impermanent loss that is greater than holding. So we never know like which strategies are going to outperform. And is it better to actually take profit here when it reaches your price target, or should you actually hold it all the way back down where there's very little impermanent loss, and then you actually make less money because of that, right? You're outperforming holding in this case. So if you hold it all the way up and down, there's zero impermanent loss, but then your net profit could be lower than if you actually just, okay, say that, all right, I didn't outperform holding, but then I'm taking profits anyway, right? So that's something to keep in mind. Don't worry too much about impermanent loss. It's like a feature of liquidity pools, right? And if you are worried about impermanent loss, then you could do a bunch of things, like for example, setting wider ranges or actually holding some MON separately, right? So if you hold your MON separately on a spot bag, as well as like, providing liquidity, then if MON price goes up, then you're actually suffering some impermanent loss on whatever is inside the LP, but then like your spot holding is not suffering any impermanent loss, right? So you're kind of like getting the best of both worlds. But what's nice about that is like if the price actually did not go up as much as you expected, let's just say the prices went up to like 0.0755, you would suffer only like 1.3% impermanent loss. And to earn like a 1.3% yield is quite easy, right? Even with a full range LP, on like a smaller cap token, it's very likely that, if you just stay in range for like a month or two, you're going to earn much more than like 1%. So that's kind of like the concept behind impermanent loss. And there's a lot of misunderstanding behind it. That's why it's important to kind of like study it and understand it. I've made like multiple videos on my YouTube channel talking about it. I recommend watching those if you haven't seen those. But basically, there's other risks as well, like the smart contract risk. If you're deploying on like more established platforms like Uniswap, it is safer, or platforms with like audits. And or if you're like spreading out your bags, right, it's typically not a good idea to put all of your funds in like a new DEX, then it is safer for that. And then there's the underlying asset risk too. So if you're not actually bullish on MON and you believe it's going to go to zero, then the best course of action is probably to just sell it into stable coins rather than providing liquidity, right? Because if we look at this chart here, if you're in a full range, if the price draws down by 50%, you're not going to suffer that much extra loss. But if it actually goes to like near zero, your capital could trend to like near zero as well, right? So you're risking that whole capital that is inside the LP, even though you're holding like a 50-50 stable to mon ratio, right? So that's something to consider. If you don't believe in the underlying asset, then you don't want to provide liquidity for that. There is a bit of a steeper learning curve. Just a chart that the tool that I shared with you guys, it took me like so long to actually learn how to use it. But, hopefully my videos and whatever I teach you guys will speed up the learning process by quite a lot, right? As I said, I spent like thousands of hours like studying liquidity pools and learning how to use these tools. And hopefully it saves you some time, right? Because if you have to learn everything from scratch, like kind of what I did, then it is quite a steep learning curve. And you can lose money over time, even if token trends up. So this is if you're running a bad strategy. So what do I mean by a bad strategy? It's like, if let's say you're providing liquidity for ETH to USDC, and again, you see this all the time, even with people that have been providing liquidity for longer than I have been, but they're running like an unsustainable and unprofitable strategy, right? So let's just say you were providing liquidity in like a $1,000 wide range, 1,000 to 2,000. What happens is, like, if prices move up, you're going to be forced to rebalance, right? And sometimes like people would chase up the range to rebalance. And then if the price basically drops, they're going to chase down, up and down, right? And in theory, like, you can't really predict where the price is going to go like 100% of the time. So you will make mistakes when like rebalancing up and down. And then what you're essentially doing in that case is you're locking in impermanent loss. So because the range is pretty tight, your exchange rate is going to be pretty aggressive. And I'll show that in a second. But basically, you're not going to make a lot of capital gains. And then you're actually trying to chase the range up. You're locking in a ton of impermanent loss. And then you're basically buying more ETH at a higher price. But if the prices drop and you're chasing down because you need some USDC in the pool, right? Then you're essentially selling your ETH at a cheaper and cheaper price. So you're buying high, selling low, repeating that process over and over. And there are like automated tools that do that for you. So they chase the range for you, and they're unprofitable over time, right? And there's still like hundreds of millions that are depositing in those protocols because people just don't know better. And then you would lose money over time running a strategy like that. Not really permanent if you can get it back from opening the position again. That is correct. But like, let's say you were chasing the range, right? Like let's say you were chasing the range from 1,000 to 2,000. You chased up to 2,000 to 3,000, and the price trend up. You technically would not lose any money because the US dollar value would not drop, right? If the price keeps trending up. But the problem is we never know when a aggressive drop, like what we saw earlier in this year, is going to come. And then when that happens, you're either forced to just sit on your hands or no yield, or if you rebalance down, then it's very likely that you're going to be locking in too much losses to actually recover from. So the fees are not going to be able to cover that losses you suffer. And you guys should be running simulation yourself. But, I've tried to make it work. It just simply doesn't work. And it could work in some instances where the fees are much, much more than like the volatility of the asset. But those types of pools typically are higher risk, where that it doesn't really happen that often. So that's something to really consider. But yeah, for beginners, I typically don't recommend tighter ranges because oftentimes you can't really like outprint impermanent loss unless you're providing liquidity for stuff like meme coins. But then, it becomes a pretty high risk strategy, right? So yeah, like Mr. Pancake says, the wider the range, the safer it is. So the wider the range, the safer it is. And then the tighter the range, the riskier it is. So that's something to actually understand about concentrated liquidity pool. And again, I will go over the example for that. But basically, if you don't have to rebalance, that's the ideal case scenario. Because if you actually like have to rebalance, then you actually have to run through like different simulations if you're actually doing it properly, right? But the problem is people don't even I would believe that more than 90% of liquidity providers don't even know how to use this tool. So when they rebalance, it's actually just not very methodical, right? They don't really have a good system when they rebalance. So they're actually could be locking in a ton of losses without knowing it. So it's like you have to go to the doctor when you rebalance, right? If you can help it and like you don't have to go to the doctor, then that's the best case scenario, right? And like having a wider range is like, making sure you're eating healthy, you're exercising, you're sleeping. It's more sustainable over time, even though it might not maybe like feel as good, right? But tight ranges is kind of like you're taking shortcuts, you're kind of like eating junk food, maybe you're taking some like stimulants to stay awake to get more work done and stuff like that. Which one is more likely, that you would have to go to a doctor, right? It's that tight range, that person that is running like that unsustainable strategy. So let's dive right into like how to actually LP before we actually do the LP, right? So what I usually do is do the scanning first, and then we simulate, and then we deploy. So scanning is like, we're trying to look for the best APR pools, right? And of course, because the mainnet is not live yet, we're not going to be able to find the best pool. But what you guys want to get comfortable using is Gecko Terminal. Most likely when the chain is live, you'll be able to use either Gecko Terminal or Desk Screener or some sort of screener that is allowing you to see like, okay, what's the volume and what's the liquidity inside these pool, right? So let's just say I want to go on like a specific chain like Sui. I could do that, right? I could go on Sui, and then I could look at like, I could put different filters, like for example, sort by 24-hour trending. I could sort by liquidity, right? What's the maximum liquidity pools? And then this is what you guys want to basically look at. And for example, there's like 2 USDC to Sui, and then this is Sui to USDC, right? And to compare it, you guys want to just look at like the liquidity and the volume that is running through the pool. And it looks like, for example, this pool is giving me more volume relative to the liquidity, right? And of course, it depends on like other factors as well, like how concentrated the liquidity is. If you look at the liquidity graph and it looks like a big mountain, typically it's not going to give you more fees compared to something that is more flat, right? So if I'm pulling up my Hype to USDT pool, for example, and this actually looks kind of flat, so it's not that concentrated, this type of graph is typically better, assuming that the volume, is like relatively the same compared to something that has like a huge peak, right? So the larger the peak, the less fees you're going to earn typically, especially if you're a wider range liquidity provider. But what you guys can do is like put on like a moving average on the volume, right? Use either the 20-day or the 30-day. And then you can see the volume has been a bit higher in the last, in the October, like the liquidation event, but it stays around like maybe 40 something million, right? The average volume. This other pool is pulling only an average of about 10 million per day, right? So knowing that, then it's probably better to be on the other pool. And then you can see like the trading fee as well, like 0.25%. It's on Cetus. And then if we go here, so we can't really see the trading fee for this particular pool. But basically, once you guys find the pools, we want to kind of dive deeper to actually compare. And maybe it's better to do the scanning on another workshop when the chain is live. But yeah, like Gerald Merrill says, it typically is a good idea to learn some TA. So you kind of like see what the price action is doing. But typically for wider ranges, it's less of a factor compared to like tighter ranges. And yes, Mr. Pancake, if it leaves your range, it's typically a good idea to actually wait a bit before you rebalance. So rebalancing is something that is typically not a good thing to do unless you're already like pretty tight and you're kind of in range and then you want to widen. And that's typically a good thing to do. Yep, Mr. Radio. Yeah, I can share some examples of the pools I entered to kind of like solidify the concepts here. But let's go over like the presentation first. But once we're done with scanning, we find like, okay, this pool looks pretty good. I want to actually run the simulation before deploying, right? Some people just hop to deploying. So like their success rate is going to be lower. It's kind of like you're trading, but then like you're not really calculating like what's the potential loss and profit before you take on the trade, right? It's very similar where like you're providing liquidity. You kind of want to see like the expected value of your pool before you actually deploy, right? So I don't want to be like, let me just wing it. The APR looks good. Let me just deploy. So let's go over the beginner strategies, like the full range LP or very wide range LP. So this is typically the best for beginners. The reason why is there's much less room for error. There's no rebalancing required where most people actually lose money. The fees will most likely be decent, especially if you get in early on launch day. And if you're using like safe dexes, right? It's easier to beat impermanent loss just because the impermanent loss is very little, like what I showed you. Of course, if the price moved pretty aggressively, like if we look at the SUI chart, right? 1 second, where it is SUI. So if the price moved pretty aggressively, like SUI does, maybe it goes down for quite a while and then it pumps back up, right? So if you actually look at the price movement, it's quite aggressive, right? On launch day, it basically trended down like 73% for like almost half a year before it started trending up. And when it trended up, there's like a 300 something percent pump, right? So that's why I say like a tight range strategy, like let's say plus or minus 30% for like a lower cap is typically not sustainable. And like if you're not holding any spot, you're going to miss out on a lot of the upside as well, right? And so it is much safer to use like wider rather than tighter, because if you actually want with like pretty wide ranges, let's say to like $10 on the upside, you would still be in range till today, right? And then if you're in range, you're earning a lot of fees in the process as well, then it's very likely that, you know, you could outperform impermanent loss pretty safe. But even from the, let's say the launch price to the absolute peak, it's about like 200 something percent. So we could simulate that here before we deploy, right? Let's just say Mon launches at like 0.055 where we deposit it. And let's just say the top price is like 0.0155, right? So 3x, kind of like what Sui did from the launch price. Then you would be suffering about 12% impermanent loss. And assuming that your APR is greater than 12%, you would be outperforming holding in the market. And then you're going to earn nice fees in the process. And you could use your fees for a bunch of different things, right? You could compound into a pool, or you could use the fees to, like, for example, mint NFTs, mint some Illuminati, right? Or you could use it to like invest into like higher risk meme coins on the network, for example, to get like, try to get like a higher return on your capital. But this impermanent loss is going to be less with a wider range. And again, you don't really have to rebalance for this scenario, right? And then, of course, if like the price goes up to your profit target, then you would have to kind of think about if you want to lock in the profit or not. And then one thing to consider also, if you don't want to sell that much MON at the beginning price when you first start, then maybe you don't want to go for a full range, right? Because like I mentioned, if you go for a full range, you do need to sell like 50% of your Monad airdrop, for example, if you are getting a pretty sizable airdrop heading into the launch day, right? So if you don't want to sell that much, then you want to adjust the range a little bit. And Meryl was saying, you know, what things do I look for before I deploy? Typically, again, the volume, I want to have like as much volume as possible relative to the liquidity. And assuming the fee tier is the same. So if it's a lower fee tier, like 0.05% compared to the 0.25% or 0.6%, then you kind of have to divide that volume by like 5 or 6 to kind of like equalize that, right? So you do have to do a little bit of math. That equivalent metric is like fees to total value locked. So the more fees relative to the total value locked, assuming all else being equal, like for example, the safety of the protocol or the liquidity distribution, right, is kind of the same, then you want to go for like the higher fee to total value locked pool. And especially if the volume is more consistent, right? But yeah, so if you want to set a, let's say a bullish range, what you want to do is, let's say the price, if we look at the price, right, 0.055 right now, and let's just say we see like a SUI type of drop, right? Let's say we launch around like 1.59 for SUI, and then it drops like 70% roughly. But let's just call like this the launch price of MON, right? 0.14. Let's just see if we drop by 70%, or if you want to add a bit of a buffer, so maybe like 80%, maybe that's your bottom range, right? So 0.0275, and you're going to be able to see the ratio with this calculator. So 0.275. And then let's just say we deposit at 0.055, right? So what you're going to see in this case is if you're setting a bullish upper range, but you're kind of like moving up the lower range a little bit, then you're actually depositing like 77% won and then about 20 to 23% USDC in this case, right? The green part is the USDC. So this is if you're more bullish on the project and you don't want to sell too much at the launch price, then you could adjust this low range to be even higher, right? And then you're going to be selling more aggressively, basically when the price is kind of like trending up from wherever your bottom range is. So the way you want to think about it is like you're getting an average price from wherever your bottom range is, like all the way up, right? So you're kind of like slowly dollar cost averaging out from like wherever the bottom range is and your deposit level if you're doing this strategy, right? So again, if you're happy to lock in a bit more profit, then you could do like a full range. Or if you want to have less profit up front and then like you're waiting for a pump, then this could be a good way to go. If we simulate, for example, to 0.15, so about a 3x, right? You're going to see there's still 14% of imprint loss. And then you're going to have like basically a 2x worth of profit. So it is going to be a bit less than just straight up like holding MON. But again, you're earning fees in the process. And then you never know like what the price is going to do, right? So if the price moves sideways, then this strategy for sure would be outperforming the just holding in the market. And we could compare that with like, for example, a full range LP, right? If I go max and then price deposit 0.055, price now 0.015. So same exact scenario, but with a full range LP, what you will notice is that you will have less of a capital gains. You would have a 65% gain with this scenario compared to this 100% gain in this scenario, right? The reason why is because the ratio of deposit is different and you're selling less of your MON from the get-go compared to, selling more from the get-go with this full range, right? So the range you set does matter. And if you don't want to sell any MON from the get-go, what you could also do is set the lower range to be at, let's say, 0.05. Maybe you sell just a tad, right? And then in this case, you're selling less than 5% a month. And then this, so shy tropical seal. Yep. So this is effectively pretty much almost a one-sided LP, right? If I move it to 0.055, then it's completely a one-sided LP. So this is like, if you don't want to sell any MON from the get-go, you want to start selling at, let's just say 0.055, even if the price drops to like 0.03, and then, you don't have to start selling at 0.03, right? So you could set your range at 0.055. You're not going to earn any fees in the process when the prices are below that level, but then you're not selling your MON at a cheap price either, right? So if you believe that, okay, MON should be worth at least 0.055, and then I'm comfortable to start taking some profit, then I want to set a one-sided pool like this, right? And then let's say the price goes to 0.015, then you would see that you would be getting much more capital gains than like the full range LP or the other LP that I showed you. But again, there's like pros and cons with each strategy, right? So for example, if the price dropped from 0.055 to 0.04, you would be earning no fees with this scenario compared to like the full range LP or the other LP that I showed you earlier, right? With the range from like, let's say 0.025 to infinity. So there's a drawback there. And again, it depends on your overall strategy. For example, this is another strategy that you guys can use. You could do a full range LP or a very wide range LP plus a spot bag if you're bullish on Monad, or if you want to lock in some profits, you could sell some of your spot bag to stables, right? So let's say you got airdrop, let's just say like 10K, right? Just to make the number simple, you could do like 5K in the full range LP, and then you sell the other 5K to lock in profits if you don't care that much about like the appreciation, right? But let's just say you're not that happy to sell at the current price because you believe like, okay, Monad is going to trade higher, potentially to be around what Sui is trading at. You can sell like a little bit into the full range LP, or like, let's say 50% in the full range LP, and then you hold 50% spot, right? And the reason why this is good is, let's just say we run through that scenario right now. Let's put 100K to make the number simple, right? So let's just say 50K, you're depositing 50K, right? Because maybe you got airdrop 100K or you bought 100K worth, either in either scenario, right? So this is a near a full range LP. And what I want to simulate is 0.055, right? So if it goes up to 0.015, like what we just mentioned, right, you would have about 33% gain in this LP, but then you'll have full capital appreciation on your spot back, right? So we could calculate that by like, okay, this is the gain from this LP. If I decide to take profits, right, 82,000 something dollars, 572, and then plus you're going to have that other 50K that you hold spot, right? Let's just call it like a 3x from the current price. So you would have another 150K, right? Because if you have 50K at 0.055, multiply that by about 3, then you would have 150K plus 150K. So then in this scenario, you would have about $232,000 worth of gains from this price appreciation plus the LP value, right? And of course, if you're depositing only a little bit into the LP, your fees are most likely going to be lower than people that are putting more into the LP, right? And you can see that you could calculate the expected value. Like for example, this strategy, okay, at 0.15, you would have 232K compared to this one-sided LP. I would have this 230K, right? But maybe this one-sided LP would maybe earn more fees on the way up. So then maybe I could like use this scenario instead. And again, there's just like hundreds of different scenarios and strategies that you can use at different ratios that you could use. So I'm not going to run through all of them. My goal is to teach you how to use this tool and kind of like give you some ideas of different strategies that you can run so that you don't have to rely on me to actually make your decisions, right? So giving you the tools is the most important goal here. And once you know how to use the tools, then you could actually basically be really good at providing liquidity, right? And one thing I do want to mention as well is when we're simulating tools, we don't just want to think about the upside, we want to think about the downside. So just like trading as well, you don't just think about the potential profit, right? You think about like, okay, how much can I lose with this trade? That's actually the most important question to ask, especially if you guys are buying MON at launch and you're not getting airdropped a huge amount, right? Maybe you're a MONAD bull, but you're maybe waiting for like the price to kind of bottom out and you want to allocate like, let's just say 5 to 10% of your portfolio to MON. You really want to simulate the downside as well as the upside. So you don't want to just be blinded by the upside. You want to kind of like simulate the downside as well. So let's just say we use the same example. Let's say you're holding spot, right? 50K, and then you're putting 50K in a full range LP. But let's just say in like the launch didn't go that well. Maybe the price go to like 0.02. What would you have in that case, right? So you would be calculating this amount. So you would have 30K in the LP, and then let's say 0.02 divided by 0.55. So you would have, let me see if this is correct. Yeah, you would have this amount multiplied by 50K on the spot back. So because you start at 50K spot and then 50K LP, right? So your spot back would decrease by quite a lot to like 18K. And then because you have whatever is inside the LP plus 3151, then you would have like $48,000 here on the downside, right? But again, with the LP would be earning money in the process. And if you were to put everything in the LP with 100K, your upside again will be less, right? Because you're selling 50% off the rip. But on the downside, you would have like 60K instead of this 48K, right? So it's all about like, okay, what risk and reward I'm comfortable with. How am I gonna like split out like the different ratio? And if I'm just like, for example, holding spot and then like everything with 100K, then for this scenario, if the price drops to 0.02 and you're running like a one-sided LP, right, then you would actually be left with like only 36K. So like a 64%. So it's equivalent to holding your MON airdrop at that point, right? So yeah, I can go over like the pseudo delta neutral strategy later on, but yeah, I can go over those strategies later on, but it is a more complex setup. And it is riskier with like lower caps simply because you could be liquidated doing so, right? With the pseudo delta or with like a hedge LP. So, but let's finish like the slides first. But if you are, for example, if you are running a full range and then you're maybe selling like some spot bags off the rip, right? And again, the ratio could all depend on what you want to do. Like, let's say you want a full range LP with like 80K, and then you want to sell like 20% off the rip. So you would have this 48,241 on the downside, right? 48241 plus 20K that you sold. So then your downside for this strategy would be 68,241. But if the price pumped to 0.015, you would have less of an upside because you sold some one off the brick, right? Yeah, you would have like 32% upside, or sorry, you would end up with 132,115 plus the 20K you sold off the brick. So now your upside is 52%. Your potential downside is maybe 32%, right? And of course, you'll be earning fees throughout the whole process. So your profit and loss would be actually greater than 52%, and your loss would be actually less than this 68%, right? Assuming that the price stays within like that reasonable simulation range that you go into. So that's the basic idea for liquidity pools. That's the basic setup that everyone should know how to do. And again, it might not seem like it's a lot of fees to go wider rather than tighter, but it is much less risk. So that's something to consider all the time. Whenever you guys are getting higher return in DeFi, it typically means you're taking on more risk, right? And so I believe I have at least another 30 minutes here or more, but basically there's like more intermediate and advanced strategies as well that you guys can run. And I will go over this. And again, like a lot of this is inside like the drippy finance course that I teach, or like some things that I teach like my clients. People do pay me pretty good money to teach them how to LP, simply because if you have like 100K or like more in a portfolio, I could probably make you more return, and then you'll lose less money in the process versus doing everything yourself, right? So, and I'm not trying to like hard show anything here, but that's why like people do pay me for like coaching and stuff like that. It's simply because if they do everything themselves, they would lose much more money, through like whatever stupid mistakes or unsustainable strategies that you might be seeing online, right? So, but this is a really good setup if you want to, for example, balance like a tight range with a wide range strategy. Like, for example, you can have like a full range or a bullish range in one LP, and then another tight range inside here in case the price actually don't move that aggressively and you want to print a lot of fees on launch day, right? So this is actually a really good setup for launch day, in my opinion. And we could talk about like this stacked LP setup as well. It's very similar, but instead of like one wide range, we could split the LP into three: one bullish range, and then one bearish range to bid some on, and then one tighter range. So this setup, the reason why I really like this is because it allows you a lot of flexibility, right? For example, if you're a monad bull, you might not even need the bearish side, right? You don't have to lock anything. You could hold some extra mon spot, and then you could just set a bullish range, or like the bullish range being what I just showed you. For example, like a one-sided pool to the upside, that's a bullish range. Or if I set a range of like 0.03 to infinity, that's also a bullish range, right? My definition of a bullish range is I'm depositing more won than USDC. And the reason why it's bullish is because I am betting on like price of won going up in value rather than, the likelihood of it going down too much, right? So you could be setting a bullish range and a tight range and a bearish range. And then maybe your ratio could depend on your market outlook, right? If you believe that MON is going to drop more than it pumps during launch, then you want to be setting a bit more in the bearish range, right? Maybe 50% in the bearish LP, 25% in the bull, and like the tight range, the neutral LP. So it depends on how you want to split it. And again, you want to run through the simulation. And I just show you like some of the basic simulation here. But if I run through like the simulation for each strategies, I think it's going to be a bit too long for the workshop. But basically, again, the nested LP, the reason why is it balances the fees and capital gains. The tighter your range, the more capital loss you're going to suffer, and then the less capital gains that you would actually get. If you guys kind of think about that, it sounds simple, but like people actually don't think about this. Is like when you set the range really tight, what you're essentially doing is like you're saying, hey, I'm happy with like a aggressive conversion rate of my bond at this current price, right? So let's just say I set a range of like 0.01 to like 0.03. So in this scenario, I'm saying like, okay, I'm happy with my bond either like going up and then I'm selling at an average price of roughly wherever I deposited and between the upper range here. So my average sell price might be around like only 0.067, 0.07. So if MON goes to like 0.25 or even $1, you're going to miss out on a lot of the upside, right? But the reason why people like me sometimes still do it is in a nested setup. If prices of MON just kind of bounce sideways, then this LP would actually be the outperformer, right? And can we actually predict that? It's, in my opinion, very hard to predict like what MON is going to do. Is it going to pull a SUI where the price goes down and then up, hopefully, right? That's why we're here in the first place. We're bullish on Monad, but you never know like where the price is going to like bottom or top out. That's why it's riskier to do a tighter range. And then you're also in a tough spot is like, if price go up, you're kind of forced to rebalance if you want to still earn some fees. And then if you chase up, you're essentially buying more MON at a higher price. So you might as well just hold your MON, compared to a very tight range strategy. So, but the risk and reward could be worth it on launch day simply because maybe the tight range could print you at least like, 5%, 10% in a single day, right? So that's something to consider. The risk and reward for like a tight range becomes lower and lower the further away we go from launch, unless we see like a massive catalyst that would drive a ton of volume, right? 1 second, just having some water here. But it's great for lower caps. It's great for building larger positions. If you are bullish on MON, this basically gives you the best of both worlds, right? If prices kind of move sideways, you have that tighter range. And then if the prices move aggressively, you still have that wider range. So you're not missing out on like as much as if you went into 100% tight range. And then you could also de-risk with tighter range position when it exits the top side. So let's just say I'm providing liquidity for MON at a lower price of, let's just say like, I believe MON would bottom out at 0.03, right? That's the bottom range. And then upper range could be at, let's just say 0.2, if I believe, sorry. Yeah, so 0.2 here. So that could be like an example of a tighter range, right? And again, you want to use that calculator to kind of simulate. But what you guys can do is if the price move up pretty aggressively, what you can do is just de-risk this pool. So you just remove this pool and then don't chase the range upward, right? So you basically took profit on whatever is inside this tight range LP. And the ratio depends on like how much you want to risk on the tight range. If you want more capital gains, maybe you go in with like 80% in the wider range and then 20% in the tighter range, right? But maybe if you're like optimizing for fees, you could go in with like 50% tight range and then 50% of a wider range. So it all depends on like your own market outlook. Or if you're trying to like degen it, you could like go 100% tight range and try to print as much fees as possible, right? And you don't care if you miss the upside, then maybe it's actually good to go with a tighter range, like, but not too tight, right? Maybe like 0.2 to 0.03 if you believe that the launch would not just launch the price of MON straight up. Because again, like the risk and reward for a tight range LP is really, really good on launch day, but in most other scenarios, the tighter range would not be something that I would pick, right? But the challenging part, again, is because we don't have any price action history. We don't know how price is going to go. If it pulls like a SUI, if it just dies down and then suddenly it starts picking back up, then you could, if your ranges are too tight, you could miss out on like a considerable upside, right? And of course, you could adjust your strategy at any time. For example, you start with tight range to play like the launch day, but accumulate a ton of fees. And then you want to like, number one, if you want to, for example, hedge the downside, you sell most of your fees to stables. Or number two, you want to be doubling down on Monad, that you're using most of your fees to like buy more MON, right? You basically like keep buying mon. And then if the price moves up above your range, at least you actually have some spot mon that you bought with your fees. Or like if the price kind of like bottom out already and you're happy with the fees, you could always remove your liquidity and buy a bunch of spot mon and just chill for a while, right? Chill for the price to recover. So it's not static. But what I will say is that like, if you're not good at like, adjusting strategies, then like it's better to just stick with one strategy and just do that thing for a long time, right? Because if you're wrong with about the price movement, for example, you start with a nested setup, price is low, maybe it bottomed out already, you switch to like 100% spot bag because you believe, okay, the price is going to reverse the upside, but then maybe you're wrong, right? The price goes down by another 50%, then you would actually be at a deeper loss in that case. So that's all. There's always a risk with like, trying to fidget with the strategies too much. But the downside with the strategy is a bit more management. It's not a big deal if you're running only like 2 pools, right? And it can underperform wide ranges if big moves happen shortly after you enter. So if prices, for example, drop too aggressively or move up too aggressively, then whatever's inside the tight range is going to underperform. You're going to miss out on some of the gains or suffer more capital losses with the tight range. But it's really good for like lower cap pools. For example, I've been providing liquidity for Pixel and ETH with a nested setup for a long time. I've been able to build like a pretty sizable position because of the nested setup. I currently am running a full range LP, and some of my pools are out of range to the downside. So when that happens, you're stuck in spot, right? So if you don't want to hold spot mon, then you don't really want to be LPing either, right? So if prices do drop aggressively, you're going to be 100% in mon in this scenario. And I will show the simulation of a tighter range here so that you guys can understand like the risk that goes into tighter ranges, right? For example, the upper price range, let's just say you put it at 0.2 and then price lower, 0.02 maybe, right? Again, it's really hard to say like, okay, what is the range that I should set simply because there's no like history of the price action, or if it's going to look like Sui, or is it going to look like Bera, right? Of course, most of us here, if you're in Monad, you probably don't believe that it's going to look like Bera, right? But like with any investing, you got to be prepared for the downside. So if we see here, you want to be happy with the deposit ratio, right? If you're not happy with like locking in a bunch of profits here or selling a bunch of mod into stables, then you don't want to set this range. So you can adjust your range depending on like how much you want to deposit. Again, the green area, the Y is the stables, right? So if I want to sell a bunch of mod, I could do like a range like this, for example, if I'm trying to bid. But if I want to have like a more balanced LP and take not too much market bias, right? Then I could do this. But what I want to show you guys is, let's say you put in 100K, price goes up to 0.15, right? What you will see is that the capital gains is going to be less compared to a full range LP here, where you would see a capital gains of around 65%. Now it drops to 45%, right? So if this happened relatively quickly and the fees doesn't really outprint the capital gains, then you would have been better off just doing the wide range, right? Like for example, on day one, you deposited at 0.055, suddenly it teleports to 0.15 in like an hour, right? So that's something to consider. And again, you can see there's 25% of impermanent loss and there's 11% for the full range LP. And again, don't worry too much about impermanent loss. You're going to suffer it regardless. And your goal should always be like net profit instead of, impermanent loss. And if the price dropped to, let's say 0.02, like what we were seeing, then your 100K would become like 47K, right? So it's not as bad as holding spot, but it will be worse than, than a full range LP, right? So that's why I say like full range LP is less risk. So you would have 60K compared to 47K in this scenario. And again, it's very helpful to run through like the calculator. Simply because you could see the ratio. But again, the reason why this could be worth it is because you could, print a bunch of fees in the process, right? If I average like a 100% APR for 1 year with this LP, I could basically get like my initial capital back, assuming the price stays around like 0.055, right? But if the price kind of stays at 0.02 to even print the initial capital back, I would need to earn like 100% APR on this 50K, right? So that's something that you guys have to consider. The tighter the range, the higher the risk, right? But with this setup, again, you're balancing the risk in this case. So the next one I want to show you guys is the hedge setup. So the hedge LP, I have a video on my YouTube channel talking about the hedge LP, but basically what you want to do is you typically want to have like a wider range LP. I think Mr. Pancake was saying like, okay, the pseudo delta neutral strategy. Typically pseudo delta, you do need to do like lending and borrowing and stuff like that. And it's a little bit more complex, but this is a bit more straightforward. So if you believe at launch price, Monad launched pretty aggressively, and or you want to farm some perp dexes, you could put out some shorts to balance your long exposure, right? Because when we're providing liquidity, we are essentially long because you are exposed to the underlying asset. In this case, it's long. So you could, for example, set a wide range, add a small short to it, and then that kind of balance out your downside risk. But you want to kind of, again, the most important is to actually simulate before you deploy, right? You don't want to like go ahead and short and then not run any simulation. And this is not something that you want to do if you don't want to protect your capital that much, because if you're protecting your capital, your upside would be limited, right? So there's no like free lunch that you guys could get. Like, okay, you have like the max protection, but then also like your upside is also really, really good, right? I will show you guys like a really good strategy to have like less downside, but like pretty great upside still. So it is kind of like a more better risk and reward, but at the same time, there's no like free lunch, right? You can't have like a magic bullet where like there's zero downside, but then you're also printing like 50% APR. That typically don't happen in DeFi. You're always taking some sort of risk. If you don't know, like if it's risk-free, then you typically don't know like where the risk is. It's not that it's actually risk-free, right? But basically, let's just say you went in with like a 3-to-1 ratio. That's what I like to start with when I run a hedge setup. So let's say it's like 75K, right? What I want to share is that, okay, if I deposit 75K, I would be depositing like 50 something percent of MON here. So roughly 50K worth of MON. And then I would use that other 25K to sell into stablecoin and then short on a perp stacks on something like maybe Purple or on Hyperliquid, right? Now, what I want to show is, let's say you do like the 1x leverage, you will be liquidated at around like 0.11 or less, depending on like the margin requirement. But let's just say it's like 0.1. What you will notice is that this 75K would turn to around 98K, right? So if you have like a 1-to-1 hedge, you're almost at like a break even at this liquidation point. So if you want in it with a hedge, it is a partial hedge, because if price goes to 0.1, let's say you liquidated with that 25K, but you got most of your initial capital back. And you can adjust this as well. Let's say I change the price up to 0.25. That is going to give me a bit more capital gains here. So then at this 0.1 price point, I will actually get all of my capital back, right? If the price actually went to 0.1, I'd have to close my position and then sell everything to stablecoins if I want to actually protect my capital with that short. So when you're actually liquidated, you kind of want to like rebalance that position, right? But for this hedge setup, if the price goes to, let's say 0.015, or sorry, let's just do 0.02, just to keep like the examples, more similar to like the other ones, right? What you will have is like close to a almost 50% drawdown on this capital, or sorry, a little bit more than a 50% drawdown, but you have that short to balance out, right? So 3-to-1 ratio, what you will get is let me do some math here, 25K. And basically it's like, if it's a 1x ratio, let's just say it's like a 60% gain, right? So 25K, because you can't really make like, with like low leverage, you can't, it's only a partial hedge, right? So let's say multiply that by 1.6. Let's say your gains from the short is 60%. You would have $40,000 in that per stack plus 34953, right? So you would have roughly 75K left if you went in with a short. And this could be a pretty decent strategy if you didn't get like a huge airdrop amount, but you still want to like yield farm on launch day, if you set a wider range, this strategy would work better rather than like too tight of a range. But basically you're still protecting like, a decent amount of your capital on the downside, right? Assuming that the price is bottoming at like 0.02. So, and again, you could adjust like the short ratio that you want to do for the hedge setup. But if you're comfortable with that, you're looking at roughly 25% downside, and then you could be liquidated at like, zero point 0.1, and you would still be at break even, right? You would be at break even with the initial capital, but at the same time, you're earning fees in the process. So let's say with this relatively wide range here, you would still most likely be earning at least like 10% for the month or like higher, hopefully like 20%. So then maybe you would earn like, 120K before you get liquidity, right? Assuming that, it took about like 2 months for the price to actually go up to above to the liquidation price. So that's kind of like the hedge LP setup. It's great for entering high APR pairs when prices are high, less risk of loss when yield farming, but you gotta monitor your liquidation level, and it doesn't work as well with like crypto to crypto pairs. So if you are, for example, yield farming chalk to Mon, then this setup is probably not that good. And it's best for like an overheated market. So I personally would not run like a hedge setup if I believe Mon's price could trade at a much higher price. Because why would I hedge my exposure if I believe that the price is going to go up, right? I could hedge my exposure without a short as well. I could do that by selling some Mon to stablecoins, right? So you don't really need to have like a short on at launch day, simply because if it's already pretty cheap and the price move up pretty aggressively, you could be liquidated fairly quickly, right? But let's just say you were looking at something like Sui, and then it's trading at like $5. It's much safer to do a low leverage short at that point compared to like, maybe something like Mon that is launching already at a reasonable, fully diluted value, right? So that's the nested LP and the hedged LP. And then we could consider the stacked LP as well. And this is something that I've recently been thinking about a lot. And I'm currently running this with like the Hype to USDT pool. And some of you guys are asking like why I deployed that, because I want to accumulate more hype while earning some fees in the process, right? So if you're looking at this is essentially what it is. It's earning about 16% APR. One of the range is from 20 to like infinity. Another other range is from like 100 to 0. And the reason why we want to have a 0 price range is it's kind of like mimicking a full range LP, where the more capital you put in here, the less capital losses you are actually suffering. And I'll show you guys here right now. So let's just say you deposit at 0.055 and then price lowered is at 0. So this is what I call a bidding LP or a bearish LP. And then let's just say the price upper, let's put like 0.15 if you believe that, okay, that's a reasonable price for Mon to kind of hit. But what you'll notice is that it's like the opposite of a bullish LP, right? And you'll be depositing 28% Mon in this case, and then the majority of it is in USDC. But what you will notice is if the price goes down to 0.02, what we were looking at, right? Like more than a 50% drawdown, so more than 60%, you would actually only lose about 30% of your capital. So the drawdown is much less aggressive for this type of range, but then you're also missing some upside, right? So you're going to be missing some upside if we go to 0.015, like what we're looking at. Your capital gains is only about 18%. So if you're bullish on Monad, you definitely don't want to have like only this LP unless you're trying to like sell first and then try to like kind of trade the charts, right? Like if you believe Mon would hit like 0.03 before it goes to 0.15, you want to do this and then capture the drawdown and then flip bullish during that scenario, right? But you don't really want to like put too much capital into this if you're not trying to protect the downside. But the good thing about this is like sometimes if the price, for example, it took a while for like the pool for the price to go down to, let's say like 0.03, for example, you could be suffering some capital losses, but then your fees might be able to outprint this capital loss, right? And if I want to deposit even less mon in the beginning, my losses would be less as well. Let's say the upper range is at 0.1. You can see the losses would be not as aggressive. So it depends highly on like the deposit ratio, right? So at 0.02, again, you would still have about like 74% of your capital if your upper range is at 0.1. But let's just set a more conservative range here. Let's just say 70K, right? Now, what I want to do is I want to also have a bullish LP on the upper side. And this essentially is very close to a full range LP if you guys kind of stack it together and do a 50-50 ratio, like what I did with the Hive pool. But the thing is, it's going to earn you more fees than a full range because some of your liquidity would overlap, right? So if you kind of overlap it like what I show, especially if you guys have a nested setup where there's also another tight range LP, maybe from 0.02 to 0.25, right? Then that could print a lot more fees than like a full range. And you will still be fine if price go down aggressively or up aggressively, because you would be earning fees regardless, right? And if one of your pools go out of range, that's not a big deal because you have the other pools. And again, you kind of want to like adjust the exposure based on your market outlook. Like let's say you are just very conservative, you're a bear maybe, then you could put like more into this like bearish LP, right? But if you're a bull but you maybe want to like lock in a bit of profit, then you could do like, 20% in the bear or maybe like 80% to the bull, and then maybe not even the tight range, right? If you don't care that much about fees. And again, the advantage with this strategy is that you could adjust the exposure value. So let's say you do like 80% bull, 20% bear, and then you could choose to compound your fees into whichever pool that you want to kind of play with, right? For example, you're earning a ton of fees and you want to like kind of be more conservative and maybe accumulate more mon on the drawdown, then you want to compound heavily into bearish pool, right? Into the bearish LP. If you believe the prices are kind of trending down a little bit, you want to accumulate more, that's what you want to do. But if you believe prices are going to go up pretty aggressively, you could compound or allocate more capital into that bullish LP. That's going to allow you to have much more flexibility compared to like a regular full range LP. So this is what I call the stacked LP. And then what you can do, if you have a ton of mon at Airdrop, for example, and maybe you're fine with like locking in a ton of profits, you could do a bearish LP with like zero minimum range. This is what I call the hammer LP. And then you have a spot holding to kind of balance the upside, right? Because if we just looked at like what I simulated, right? Your drawdown will be less, but then your upside is capped pretty heavily as well, right? So let's just say you were airdrop 100K, again, to make the number simple. Let's say you put in 80K to kind of inside this hammer LP, right? Let's just say price upper is 0.15, price lower is 0. And then let's just say the price dropped to, again, 0.02, right? What you will notice is that with this 80K, you will still have 56,000 something dollars left versus holding spot. Your airdrop value would drop by more than half, right? But 0.02 divided by 0.455, whatever spot mon you have left. So let's just say like it's 20% in this instance, you want to multiply that by 20K, right? So because it's like you would have 36% left if the price went from 0.055 to 0.02, but let's just call it 20K multiplied by that amount. You would still have $7,000 left on that spot bag and plus 56557. So then the max drawdown for this strategy, assuming that the price bottoms at 0.02, is about like 46%, right? So you're suffering a 46% drawdown. But let's just say the price goes up to 0.15. What you will notice is that the price would be at 94K for this bearish LP. And then if it's 0.15 divided by 0.455, we're getting about like almost a 3x, right? Multiply that by 20K, our spot holdings, you will have this amount plus 94742. So you would have like around 50% worth of gains. And again, you will earn like fees in the process so that you're getting like a more balanced upside and downside exposure, right? On the drawdown, you would stand to lose almost 40%, but on the upside, you would stand to gain about 50% plus like whatever fees that you're going to earn. So it is a pretty good strategy if you're trying to lock in some profits and then you want to bid some mon on the drawdown, but then you also don't want to miss the upside, right? So then you're kind of like balancing these two. And again, you could just use this stack LP as well. But yeah, so I have a couple more minutes here, around like 7 more minutes before I have to go. But hopefully this workshop was helpful so far. But yeah, I wouldn't be like over leveraging or playing with too much leverage when you guys are yield farming on or using low caps in general. We saw that huge flush on like tokens like Sui. People that were running like leverage strategies on Sui probably got liquidated, right? And then if the price move up pretty aggressively with like different pseudo delta neutral strategies, you could be in a pretty bad spot as well. So I personally would not be, trying to do too much like fancy stuff with like Mon, especially because it is a newer token. There's no like price history and you never know if the price is going to like rocket up or rocket down, right? So it is safer again to use a, wider range strategies. And again, if some of these strategies are too complicated, then you could just do like the wider range, right? And if you guys are really heavily into the Monad ecosystem and maybe you want to actually accumulate more Mon, then like you could also consider like the ecosystem tokens depending on the actual tokenomics, right? You could, for example, have like a Chug and Mon LP or Pixel and Mon LP when Pixel migrates over. That's going to allow you to accumulate these two underlying assets. And then again, the ranges, everything I said in the course, not the course, but the workshop applies, right? So if you're like a Monad Maxi, maybe this is like some pairs that you could consider depending on where they launch or when they launch, right? So that's something that you could consider as well. And this typically would have more of a drawdown if the underlying asset don't do well, but they also have more of a potential upside if the assets do well, right? So if you do want more upside from Mon, then this is something that you guys could look into. And then we could probably talk about this later on when these tokens are actually live on Monad. And position management. So if there's no question, I will kind of wrap it up here with some of these other slides. This is what I typically do for projects that I believe in. It's a smart compounding strategy. When prices dip below my entry, and let me just pick like a random token here, for example, Solana. Let's just say this green line is my entry, and I've basically developed this strategy, and it actually has been quite profitable for like me and my clients. What it is basically if prices drop below your entry, what you want to do is you compound your fees more aggressively into the LP, right? What that is going to do is that it's going to drag down your entry if you actually look into how like it works. And then if price goes above, we could de-risk our fees into stable funds, right? And that's typically what you want to do anyway. You don't want to sell too much when the prices are cheap, right? Assuming that, the token you are LPing is going to move up and to the right over time. This is a really good strategy. So you compound down when prices are below your entry, and then prices are up. You keep de-risking, right? If you don't want more exposure. So that's what smart compounding is in a nutshell, but that's a really good strategy to do on like blue chip pairs. And then you could focus on de-risking first as well with the fees. So if you're printing a lot of fees, you're more conservative, you can sell it all into stable coins. But if you are a Monad bull, you could, for example, use a bunch of the fees to buy a bunch more of the spot Mon, right? Again, this is especially important if you guys don't want to miss like the upside and you're running maybe like this strategy or only the tight range strategy, then your risk is kind of like with the tight range to the upside and the downside, right? So you could be buying much more spot Mon too if you're trying to accumulate Mon, but these are like the main mistakes to avoid when providing liquidity. The first one is thinking too short term. You don't want to be providing liquidity and then like you're trying to make a ton of money in like a day or two, right? Typically for liquidity providers, depending on your strategy, if you're trying to trade or not. If you're not trying to trade, I typically look at like at least a 6 to 12 months time horizon, because sometimes we do see like tokens like Sui draw down very aggressively during launch, and then it just takes off like, 6 to 12 months after, and then it draws down again and then takes off once again, right? Of course, this is the chart that we are betting on if you are a Monad long-term investor, right? So we don't want to think too short-term here. But if you want to lock in some profits, again, I did show like the strategies that you guys would use. If you set the ranges too tight, that's typically really bad, especially if you are new. If you range chase too much, that's also pretty bad. I went over that earlier on. When you're range chasing, you're essentially buying high and selling low. If you rebalance too much, typically you're losing money. Or if you're just chasing APR, right? You don't want to be tricked by like these platforms that say like, hey, you're going to earn like 100% APR, especially with like a plus or minus 10% range, right? Those APR is not going to be sustainable. And then that's basically what we have to worry about. So that's pretty much it for today. I do have to run pretty quickly here in like 2 or 3 minutes, but I will give out some whitelists if you guys haven't had a whitelist. I think, let me ask some questions. I will have a pop quiz if you guys don't have questions for the 3 whitelists. First one is very easy. Get your fingers ready, warm up your fingers. Whoever gets it first gets a whitelist. So which type of strategy would suffer more internal loss, a wide range or a tight range? Go. Yeah, I'm going to give it to Mr. Crayola because it's a autocorrect page. Yeah. 1 second. So another question is, if you're following a smart compounding strategy, when is the best time to compound your fees? Down. Yep. It is low and below your entry. So I will give it to Shy Tropical Seal here simply because it is more accurate. It is like when it's below your entry to be exact. And then let's do another question here. 1 sec. How do you hedge your upside if you don't want any imperil loss when you're providing liquidity? Hedge the upside like price going up. Yeah, Mr. Pancake is right. Spot back. So I will ascend you here, Mr. Pancake. I believe ascended does get like 2 minutes. Yeah, so if you guys want to like hedge the upside and not miss out on the pump too much, then you want to actually have some spot backs, right? So you don't want to put all of your capital into like a bond to USDC pool. You want to actually have some spot bags if you believe that bond is going to like 3x, 10x, or even go to like $1, right? So hopefully this workshop was helpful, guys. And thank you once again for attending. I will try to run like more workshops in the future if you guys find that it was helpful. Yes, you can use liquid staking token for MON for hedging the upside, assuming, you know, the liquid staking tokens are safe, right? You kind of want to look into like the protocols and like the audits, see who they're like backed by and stuff like that. Thank you guys for attending. I'll hop off right now because I gotta go. Thank you guys. I'll see you guys in the chat. Hey,